I'm making this video to help beginners in the stock market, and this will be so helpful to a lot of people. Today's video is a stock market for beginners video about dollar cost averaging in and out. So here's the situation. When you're buying stocks, when you're looking to buy stocks, you want to buy low and sell high, right? So when you see a good stock fall in price, a lot of people get excited because they see a buying opportunity. Most people, when they see that happen, a good stock falling in price, they want to buy, and they want to buy right now. Now. But what's the fear and what's the danger? I mean, we've all been here. The fear and danger is that when you buy right now, the price will continue to go down. And if that happens, then you'll lose money. You'll feel bad, you'll get anxious, and you'll keep checking your phone constantly. So let me solve this problem for you. Let me give you a two-part solution. And the first part is that you need to reduce the size of your purchases. You need to get your size incorrect. So I personally would not make any one stock more than 10% of my stock market portfolio. No matter how much you love the stock, no matter how revolutionary that you think that company is going to be, just don't do it. Don't go more than 10 of your portfolio. I would say spread your risk. Spread your risk. I'm sure that you can find 9 other stocks, 9 other amazing companies that you think will be just as awesome as the one that you're relooking at or the one that you found. You're going to be disappointed every time you check your phone. Every time you check the price of your stock, you're going to be like, oh, nothing happened. Oh, like I'm still not rich yet. If you have 10 stocks, I guarantee you something is going to be popping off every week. Something is going to be going down and you're not going to be going stir crazy if you have 1 stock. Okay, God forbid that stock goes down. If that happens and you have 1 stock, then it's going to be so crushing. So trust me, you're going to get a lot of financial and emotional benefits by diversifying your portfolio, and you have to. I have to. I would say that, this is where most investors go wrong because they can't control their emotions. You need emotional discipline to become a successful investor because the markets are going to be irrational, and your emotions, they will be tested. And when you get emotional, it's going to cloud your judgments, and you can do very stupid things. So listen to 10 max allocation. That is not a golden rule. Some investors will go at 5%. Some will even go 3%. Other investors will go at 15%. All I'm saying is that you just don't want to go all in on 1 stock. Yes, you're going to hear the glorious stories of people that went all in on 1 stock and they hit it big. But you're not going to hear the other stories of the people that went all in on 1 stock and they missed. Those are the untold stories of sorrow and regrets and misery. I don't want that to be the story of your financial life. Okay, so I said that there are 2 things. The first part was no more than 10% max allocation to 1 particular stock, right? Next, so the second thing is that when you're buying a stock, you want a dollar cost average you want a DCA, dollar cost average. So let's just say that you have $10,000 in your stock account, your stock portfolio. And let's say that you want to allocate $1,000 to SLV, which is a play on silver. Okay, the price of SLV right now, this is just an example. So the price of SLV right now is at $20 a share. You have $10,000 in total and you want to buy $1,000 worth of silver. 10% allocation, right? So do not take that $1,000 and buy SLV all at once at $20 a share. Don't do that. I would say rather you should dollar cost average and DCA. And so what I'm saying is take that $1,000 to buy up SLV, little by little, not all at once. So for example, pick up $400 worth when it's at $20 a share. If you buy $220 a share and it just shoots up and it never looks back and never comes down, then great, you made money. If you buy the $20 a share, the $400 is worth, and then it falls to $19, I would say buy another $300 worth. And at that point, if it just shoots up, if it skyrockets up, if it never goes down further, then that's great. Then you made money. If you bought it at 20 and 19 and it falls to 18, then buy another $300 worth. And at that point, you will have deployed your full $1,000. But now, by doing this, You are now averaged in at approximately 19 a share, and you read much better off than if you were just to buy it all at once when it was at $20 a share. So this is good, and you should be happy. Now I want to tell you about this because this is something funny that LL happen, and a lot of people that do this still agree. They'll completely understand where I'm coming from. So if you buy your initial batch at $20 a share, a part of you will actually be rooting for the stock to go down. For the stock to go down further, because that would be an opportunity for you to purchase more at a better price. So I'll just say this. When you dollar cost average in, if you make your initial purchase at 20, you're not going to be going crazy if it goes up or down 50 cents. Because if it goes up 50 cents, then you're going to be making money and you're going to be happy. If it goes down 50 cents, it's going to be closer to another buying opportunity at an even better price. So you're going to see this as a win-win situation. So listen, you are not going to be able to get precisely the absolute rock bottom price when you're rebuying, and you're not going to be able to precisely get the absolute pinnacle, the absolute top when you're selling. But this way, by DCA, in and out, you're going to be able to get close to it with a systematic approach. This is going to be a game changer for most people, especially when you're selling your stocks or your crypto. It's the same concept when you're selling. I've noticed that cryptocurrency investors have learned this a little bit faster and taken this more to heart compared to stock market investors. I know there's a lot of overlap here. Many invest in both stocks and cryptos. I'll get to the cryptocurrency parts. But first things first, you have to sell the top. Their economic cycles, bull markets, bear markets. Yes, the timing and volatility of different markets will be different, whether it's silver, gold, oil, growth stocks, S&P 500, Bitcoin, whatever it may be. Different markets will fluctuate differently. I'm bringing up cryptocurrency investors because I think they've learned the hardest and fastest through experience. You can ask any cryptocurrency investor from 2017. A lot of them got rich in 2021 because they knew when to sell. Hopefully, people from 2021 learn for 2025. It's very unlikely that you're going to sell the absolute pinnacle, the absolute top. But when you do sell, you want to stagger out in batches. You won't $2 cost average out. If you think Bitcoin is going to $100,000, let's say that's the top range of the next bull run, then I would say get your sell orders in starting at $80,000. $90,000, $100,000. Maybe save a little bit of an order for $105,000. If Bitcoin shoots past that to $120,000, I would say who cares? You made so much money anyway. Besides, you know that it's going to come crashing back down from $100,000 to $20,000. If it only hits $90,000, at least you offloaded the bulk of your position near the top. By selling out in batches, you are reducing the chances that an all-or-nothing event goes badly against you. For example, if you put a sell order in to sell all your Bitcoin at $100,000, but it only reaches $90,000 and crashes back down to $20,000, that's going to be pretty rough for you. What's the moral of the story? Get rid of the all-or-nothing approach, the all-or-nothing mentality. Go big or go home. Instead, dollar cost, average in and out. By doing so, you're going to reduce your emotional damage and become a better investor. You may think I'm oversimplifying this, that it sounds too easy, but trust me, it's not. This is actually harder than it sounds. That's because if you want a DCA in and out, it requires patience, which is very lacking among a lot of investors these days. It requires discipline. I highly encourage you to start utilizing this dollar cost average approach on your purchases and on your sales. This is very important. You can use this staggered exit approach in many ways. For example, I have Exxon, stock Exxon. A lot of people ask me when I'm going to sell it. That's a very good question. I'll most likely sell Exxon when it becomes overvalued, when it runs up too hard, too fast, more than it's justified. When will that be? One scenario of multiple. If oil shoots up to $130 a barrel to $150 a barrel, if the price of Brent crude oil gets to $130 a barrel, then I'll start selling off some of my Exxon stock. If oil gets to $140 a barrel, I'll sell off some more. If oil gets to $150 a barrel, I would be completely out of my Exxon position, because if oil gets to $150 a barrel, investors would FOMO into oil stocks. They would FOMO into Exxon. They would drive up the price, But oil at $150 a barrel would be unsustainable. Oil would come down, and Exxon stock would fall back down accordingly. So you can use an underlying asset, an indicator, or an index to determine how you will dollar cost average out of a stock. I'll give you another example. Let's say that you have Ethereum, or Cardano, or Dogecoin, or whatever altcoin. You can have a strategy that you're going to start selling your altcoin positions when Bitcoin hits $80,000, $90,000, $100,000. Because if you buy Cardano right now and you say that you're going to sell Cardano at the peak of the next bull run, and you're not paying attention to Bitcoin, then you're going to be in the dark in terms of what prices to be staggering out of Cardano. So you see what I'm saying? Just keep that in mind. You could do the same thing with the S&P 500 or the Nasdaq when you're looking at individual equities. When you're dollar cost averaging in or out, you could look at it from a bottom-up approach or a top-down approach, or both perspectives. I hope this has been helpful. Please check out our Patreon website. We have exclusive content on stocks and investing. It's a great place to learn. I'll leave a link down below in the description of the video. Thank you for all the support, and I wish you a very nice day. Please, take care.